Hello, everybody. Welcome back to another edition of CNF Talks. Today I have with me Patrick Sarch, who's a partner and head of UK Public M&A at White & Case. Patrick will be speaking at our upcoming conference on M&A, the M&A Summit 2024, which is being held in London on the 21st of October. Patrick, welcome.
Thank you. Pleasure to be here.
Great to have you with us. Let's turn to our first question. At the summit, you're going to be addressing successful deal execution, focusing on too close to call deals, techniques for securing success, the strategies of event-driven and swing investors, and their increasing influence on deal terms, structures, and outcomes. Could you elaborate on what you mean by this?
Thank you. Well, look, it's quite a big area and it's quite an exciting one for people like me doing these transactions. A phenomenon that's always been present in the market is investors who are either kingmakers in that sense of being swing investors. So quite often they'll be in a medium-sized company, a major shareholder with 5, 10, 15, or sometimes a higher percentage than that, who will ultimately determine who wins a competitive situation or whether they're willing to accept an offer.
Yeah.
Over the last 10 or 15 years, we've seen more and more merger arbs come into the market as well. So investors who make it their business to buy shares of a company that's potentially or actually under offer, and then try and make either a small profit by trading the risk that the deal will go through, or the upside of a higher offer emerging from the same bidder or another bidder. And then we've seen the major growth in the number of activists who are actively trying to bump the deal, arbitrage, or block it. And there are lots of a number of household names there, but lots of others who are less famous or less visible engaged in this activity. And I used to say that, we often look at deal protections, and since 2012, the Takeover Code changed to remove a number of possible deal protections like break fees and matching rights and all that good stuff that we still see in other markets. So there's a lot less deal protection available apart from really getting shareholder support and irrevocable undertakings. So we used to say this was a risk on most deals. It's now being seen on very many deals. And if we looked at the data, and I've got on my other screen in front of me, 12 deals in the last year or 18 months, since the beginning of 2023, where the outcome was very close indeed. So just looking at the list, 76.92% of shareholders approved a scheme where the minimum is 75%, 77.83.5, 68.2. So that one failed. 75.14, I mean, incredibly close, right? And so on and so forth. The mean on those being 79%. So too close to call deals. So when you embark on a takeover offer, either as a target board deciding whether to recommend, you need to take all this into assessment as to what your existing shareholders think of the deal and whether they will support it. But also, the register will turn over quite quickly. Merger arbs and others and potentially activists will come in. What are they going to do? And on the bidder side, before you launch into a highly committed transaction, how do you deal with these dynamics? How do you engage some of these investors? So for me, it's fascinating, and it's a sort of change in the way the game is played, although each of these activities has always been present, right? They're just aggregating to a much more unpredictable situation and deals on a knife edge in many more cases than ever used to be the case.
Yeah, it must be very complex for bidders in this situation because, in a sense, they're having to take account of the unknown. They know there's a possibility of merge arbs being there and the other players, activists, investors, and so on, but they don't know in what quantity, they don't know which one. So that must make it very difficult. And I suppose also from a defence point of view, for a company that's being subject to a takeover, with them, it makes their defence fairly complicated.
Indeed, and so a great deal of thought goes into that. So wargaming situations. One of the complexities or complicating factors is the extent to which investors can or can't speak to each other because of market abuse and information issues. If they gang up together, then they might be acting as a concert party. If they are just aligned named publicly or privately, they may not, and the dynamics around are highly legal or legally governed, which is good for us lawyers to help
Mm.
our clients navigate. Um, and also, then there are the techniques for dealing with them. So, do you switch from a scheme arrangement to a takeover offer with a higher or
Yeah.
lower acceptance condition? Do you declare your offer to be final, or that you
Mm.
won't extend it in time, etc.? So, these are the dynamics we're looking forward to talking about at the conference.
Very good, very good. Another theme of the conference is looking at taking public companies private, which over the last few years at least has been a very popular activity. But why is it continuing to be so popular as public markets are improving somewhat? And can anything be done to encourage more public deal making, do you think?
Yes, so look, take privates are sort of, in my years of practice, have always been quite popular. I think we've seen, however,
Mm.
over 20, 30 years, the rise of private equity as a sort of asset class, and one that's
Yeah.
focused on the UK listed company target universe.
Mm.
Ebb and flow a little bit in terms of their appetite. At the beginning of this year, we saw a resurgence of strategic buyers or corporate buyers as compared with private equity. That was
Yeah.
before interest rates had topped out. So
Mm.
last year, I think I've got the data on my wall here. Last year, we saw private equity representing 70% or more of takeover offers in the UK. The first
Yeah.
half of this year, it was more than half were strategic buyers, right? Um,
Mm.
since then, we've seen the return of private equity on top of that, and the reason for that is primarily interest rate cycle. So as interest
Yeah.
rates have topped out and are beginning to go down, private equity are more able to economically borrow money. The money was
Yeah.
always there, but the returns are hugely
Mm.
affected by the cost of that borrowing. So
Yeah.
taking from private is most popular when financing is economically available. Of course, when equity valuations of listed companies are low, and they have been very low. If you
Yeah.
look at PE
Certainly in the UK. Yeah.
the UK, exactly. So
Yeah.
PE multiples in the UK are almost half those in the US over the last few years. So
Yeah.
basically, buy earnings in the UK for half the price of a US equivalent company.
Yeah.
Um, it's popular to take companies private, partly because you can leverage them up more than is considered comfortable by public market investors. You can
Yeah.
highly incentivize management in a way that's more difficult to do so in a listed company environment.
Yeah.
There are very hawkish sort of rules about that. And you can buy and sell businesses. You can either bolt on more businesses and scale up the business, or get rid of non-core assets, restructure it in a way that's more difficult to explain to investors in a listed company in the
Mm.
private environment. One thing that we have seen, I would say, in parallel with the rise of private equity over 20 years or so, is the rise of other financial sponsors. So sovereign wealth funds and the big
Mm.
pension superannuation funds from Canada, US, Australia, etc. Often those club together to get these consortium deals, which are capable of buying multi-billion-pound companies, consortium
Yeah.
bidders. And then a recent phenomenon, I think, which is very much the flavour of the month, or at least the vogue of 2024, is majority shareholders or founders buying out the minority. So
Mm.
where a major shareholder, often but not always a founder, has decided that they can better grow the company in a private context, they
Yeah.
can borrow growth capital, they can incentivize management, and they can reshape the business. And the
Yeah.
company is frankly underloved and undervalued by the market. They're buying out the minorities. We completed one of those this summer. We're working on another one. We're talking to clients about several more.
Mm.
So that
Mm.
is an ongoing process of de-equitization of the market,
Yeah.
which follows the flow of funds away from being invested in UK equity. I'm happy
Yeah.
to say that the prospects of that reversing slightly are strengthening. So we are expecting to see more IPOs coming to market, more new listed companies, and more
Yeah.
investment for them in 2025. Not guaranteed, but
Mm.
it's looking approximate than it has for some time. So it's all part of the ebb and flow. Ultimately, these take privates, when they're successful, and they often are are the best way of actually allowing a company to sort of re-engineer its business model, its balance sheet,
Mm.
and back to market in due course as a bigger, better company,
Yeah.
as opposed to being a bit of a zombie company that might be stuck on the market with no liquidity.
As you say, all part of what is quite a healthy ebb and flow of
I
restructuring and so on. Yeah.
Releasing capital into public investors' hands to deploy elsewhere, and we're facilitating those companies. One might call it creative destruction, but as you say, I think it's a healthy flow of capital between companies and businesses coming on and off the market. We just need to make sure that the market is strong. All listing reforms are obviously designed to do
Yeah.
that, ensure more companies coming to the market.
Yeah, which is clearly what's going on currently. But final question. The government recently published its annual report on the national security and investment regime. Do you think national security screening is becoming a more significant factor in M&A deals, particularly in sectors such as defence, energy, and telecoms?
Sort of yes and no, if I may put it that way. So FDI, foreign direct investment, and especially national security screening has proliferated globally in recent years for all sorts of obvious geopolitical reasons.
Yeah.
For many years, we've dealt with CFIUS, the Committee on Foreign Investment in the US, on any transactions which might involve suppliers to the US Defence Department or defence interests. The UK national security investments regime came in a couple of years ago for similar reasons, and we've seen similar regimes introduced, in New Zealand, Australia, and all over the world. So we do a lot of FDI screening whenever we're looking at businesses. Obviously, a lot of the value in the world, to state the obvious, is in strategic assets, where there's natural resources, which are particularly sensitive in some of those countries, or technology. And a lot of the growth in, certainly listed company investments has been in tech companies or those with a strong tech aspect. And therefore, that plus geopolitical sensitivity with some of the more challenging things happening in the world, unfortunately, mean that more deals actually deserve more scrutiny on a national interests and strategic interest basis. And that's what's happening. On the other hand, very few deals are actually being blocked, right? So there's quite a lot of process around this, and rightly so. And unfortunately, there's a significant delay while the process has gone through in many cases. And that can be a deterrent to doing deals. If a deal's going to take 12 to 18 months to do, some bidders won't do it. It's too distracting. It's too risky. It's not a good enough sort of equity story for the investors. However, only a very few number of deals are actually blocked or have significant kind of structural remedies imposed on them. And everybody's pretty used to dealing with competition and merger control regimes. So on the whole, it's definitely becoming a more significant part of the analysis, dealing with all these regimes, including in the UK. But very few are blocked. I think it's only 4% of UK deals had scrutinised by the Investment Security Unit actually had formal remedies imposed on them, and even fewer than that blocked. So as long as you have the finest advisors coming up with the best solutions and engaging with the authorities in the right way and actually making the right judgment call on what is doable and what is not, it's not actually an inhibitant to executing deals. And there are some rather obvious areas of sensitivity in terms of the acquiring country, or the origin of the acquiring company, whether it's state-owned, and certain industries. Where I think ultimately it's more difficult is in the kind of margin cases where there are dual-use products or someone supplies something not necessarily earth-shattering to a state. And those cases might be caught by the regimes and bear scrutiny and delay and process and cost. Actually, it's not like you're buying, some sort of nuclear facility,
No, quite.
of a difficult buy.
Yeah, I guess it's a reflection of the changing world and the dangers that exist in it, and the economic disengagement that flows from that. But Patrick, we're out of time. For our viewers, just to say, if you'd like to hear more about these issues and related issues, please do attend the M&A Summit 2024 being held in London on the 21st of October. More information on our website, www cityandfinancial.com. Patrick, thank you so much. That was fascinating.
Thank you very much.